Most traders believe their biggest problem is finding winning trades. It isn't. The real problem is what they do after they're already wrong. Think about that for a moment. How much time have you spent searching for the perfect entry, the perfect indicator, the perfect setup, and how little time have you spent mastering the simple act of getting out when you're wrong? You already know how to enter a trade, but do you truly know how to exit one when it turns against you? Let's start with an observation. Watch your own behavior the next time a trade moves against you. Not in theory. Watch it in real time. The moment price goes a little below your entry, something shifts internally. You stop thinking like a trader and start thinking like a defender. You begin to justify. It's just a pullback. It'll come back. I'll give it a little more room. Have you noticed how quickly your logic changes once money is on the line? Before the trade, you were precise. You had a plan. You knew exactly where you were wrong. But once the market disagrees with you, that clarity fades. Why? Because cutting a loss feels like admitting you were wrong, and most people would rather lose money than admit that. Now let's explain what's really happening. The market doesn't care about your entry price. It doesn't care about your analysis. It only reflects supply and demand in the present moment. When price moves against you, it's not random, it's information. But here's the part most traders miss. A losing trade is not just a financial event. It's a psychological test, and most fail it, because instead of asking, "What is the market telling me right now?" they ask, "How can I avoid realizing this loss? Do you see the shift?" One question leads to clarity, the other leads to damage. When you hold a losing trade, you're no longer trading the market, you're trading your own emotions. Now consider the implication. Small losses are manageable. Large losses are crippling. But large losses don't appear suddenly. They grow out of small ones that were ignored. A trade rarely goes from slightly wrong to catastrophic in a single move. It gives you chances, signals, warnings, lower highs, weak bounces, increasing momentum against you. And yet, how often do traders sit through all of that, doing nothing? Why? Because hope is easier than discipline. But hope has a cost, and in trading, that cost compounds quickly. Let me ask you something. How many of your biggest losses started as small, manageable ones? Here's where it becomes practical. Cutting a losing trade early is not about being reactive. It's about being prepared. Before you enter any trade, you should already know one thing with absolute clarity. Where are you wrong? Not where you're uncomfortable. Not where you'd prefer to exit. Where you are objectively wrong. Because if you don't define that point in advance, you will move it later. You will negotiate with the market, and the market does not negotiate. So ask yourself, do you truly define your invalidation level before every trade, or do you figure it out as things unfold? Let's go deeper. There are subtle signs that a trade is failing, even before it hits your stop. Price hesitates where it should accelerate. Breakouts fail to follow through. Volume doesn't confirm your idea. These are not dramatic signals, they're quiet. Easy to ignore. But they matter, because strong trades behave a certain way. They move with intent. They don't linger. They don't struggle. So when your trade starts to feel heavy, slow, uncertain, what is the market quietly telling you? And more importantly, are you listening? Now think about the cause and effect chain. You hesitate to cut a small loss. If the loss grows, your emotional pressure increases, pure decision-making worsens. You hesitate even more. This is how traders get trapped, not by the market, but by their own unwillingness to act early. Cutting losses early breaks that chain. It keeps you clear, flexible, in control. And control is everything in trading, because once you lose control, the market will expose it. Let's talk about application in real terms. Start treating your stop loss not as a suggestion, but as a decision that has already been made. When price reaches that level, the trade is over. No debate. No second chances. But here's something most traders overlook. You don't always have to wait for the stop. If the behavior of the trade changes, if the conditions that justified your entry no longer exist, you can exit early. In fact, the best traders often do. They don't wait to be proven completely wrong. They respond to evidence as it unfolds. So ask yourself, are you reacting to price or are you reacting to your feelings about price? There's another layer to this. Cutting losses early isn't just about protection. It's about opportunity. Every dollar tied up in a bad trade is a dollar you can't use in a better one. Every moment spent hoping is a moment you're not observing the market clearly. So when you hold on to a losing trade, you're not just losing money, you're losing flexibility. And flexibility is what allows traders to survive long enough to succeed. Now consider this carefully. What if your goal wasn't to be right? What if your goal was simply to avoid being very wrong? That one shift changes everything. Because trading is not a game of perfection. It's a game of damage control. The traders who last are not the ones who predict the market best. They're the ones who manage risk best. And risk is managed not when you enter, but when you exit. So the next time you're in a losing trade, pause for a moment. Ask yourself, am I staying in this trade because the market still supports it, or because I don't want to accept the loss? Be honest. Because that answer will define your future as a trader. And if you start to notice a pattern, if you see yourself holding, hoping, delaying, then the issue isn't your strategy. It's your willingness to act when it matters most. Cutting losses early is simple. But it isn't easy. It requires you to go against your instincts, to accept discomfort, to act without hesitation. And that's exactly why most people don't do it. But if you begin to practice it, consistently, deliberately, you'll start to notice something subtle. Your trades become cleaner. Your mind becomes clearer. Your confidence stops coming from being right, and starts coming from knowing that even when you're wrong, you're still in control. The market rarely surprises you. Most losses grow because you ignored its early warnings. Think about your last bad trade. Did it truly collapse out of nowhere, or did it show signs of weakness long before the damage became obvious? If you replay it carefully, you'll often notice that the clues were there. Subtle, quiet, easy to dismiss, but present. A trade that is working tends to move with clarity. It pushes in your direction with intent. Pullbacks are controlled. Momentum feels aligned. But when a trade begins to fail, the behavior changes. It hesitates where it should move. It stalls when it should accelerate. Breakouts lack follow-through. Price struggles instead of flows. Have you ever noticed that shift and chosen to ignore it? This is where most traders go wrong. Not in analysis, not in entry, but in interpretation. They see the warning signs, but they don't treat them as signals. They treat them as noise. Why? Because accepting those signals would require action, and action would mean admitting the trade is not working. So instead, they wait. And in that waiting, the loss grows. A weak bounce becomes just a pullback. A failed breakout becomes a shakeout. A clear change in momentum becomes the market being irrational. Each explanation feels reasonable in the moment, but all of them serve the same purpose: to delay the decision to exit. Ask yourself, when a trade stops behaving the way you expected, what do you do first? Do you reassess, or do you rationalize? Because the market speaks through behavior, not opinions. It doesn't announce that your trade is wrong. It shows it through subtle changes in structure and momentum. Lower highs start forming. Support levels break without strength. Buyers or sellers fail to follow through. These are not random movements. They are information. But information only has value if you act on it. The problem is, early warnings don't feel urgent. They don't force you out. They give you room. And that room becomes a trap. You tell yourself you'll exit if it gets worse. But by the time it gets worse, your emotional attachment is stronger, your loss is larger, and your ability to act is weaker. So you wait again, and the cycle continues. Notice the cause and effect. You ignore a small signal. The trade weakens. You justify staying, the loss increases, your flexibility decreases. The next decision becomes harder. This is how small losses turn into large ones. Not because the market was unpredictable, but because you refused to acknowledge what it was already showing you. Now consider the alternative. What if you treated early weakness as meaningful? Not as a reason to panic, but as a reason to pay closer attention. What if the moment a trade stopped behaving as expected, you shifted from confidence to observation? That shift alone changes everything. You stop defending the trade. You start evaluating it. You begin to ask better questions. Is momentum still aligned? Is structure still intact? Are buyers or sellers still in control? And if the answers start turning against you, you don't wait for confirmation through pain. You act on the evidence already available. Because by the time a loss feels obvious, it's already larger than it needed to be. The market doesn't need to surprise you to hurt you. It only needs you to ignore what's right in front of you. Your stop loss is not where you panic, it's where your idea is proven wrong. Most traders place a stop loss the same way they make many of their decisions, reactively. Price moves against them, discomfort rises, and somewhere along the tension, they decide, I'll get out here. But that's not a stop loss. That's an emotional boundary, not a logical one. A real stop loss is defined before the trade even begins. It has nothing to do with how much pain you can tolerate. It has everything to do with where your reasoning no longer holds. Think about your setup. You entered the trade based on a specific idea, maybe a breakout, a support level, a trend continuation. That idea implies a structure. It assumes certain conditions will remain true. Now ask yourself, at what exact point does that structure break? At what price does your original reasoning stop making sense? That point is your stop. Not because you feel uncomfortable there, but because beyond that level, your trade is no longer valid. Have you ever stayed in a trade simply because it might come back, even though the reason you entered it had already disappeared? This is where confusion begins. Traders mix discomfort with invalidation. They think if I can just handle this drawdown, the trade will work. But the market doesn't reward tolerance for pain. It rewards clarity of thought. And once your idea is broken, staying in the trade is no longer analysis. It's hope. There's a critical difference here. A trade can be temporarily uncomfortable and still valid, but it can also be comfortably wrong. Price can drift slowly against you, never triggering panic, yet completely dismantling your original premise. So how do you know the difference? You go back to structure. If you entered on a breakout, then a return below that level isn't just noise, it's failure. If you relied on support holding, then a clean break and acceptance below it isn't just a dip, it's invalidation. If momentum was your reason, then loss of momentum is not a minor detail, it's the core signal changing. And yet, how often do traders ignore that shift and move their stop further away? They tell themselves they're giving the trade room. But in reality, they're giving up their discipline. Because once you move your stop without a new, valid reason, you're no longer managing risk. You're avoiding a decision. The danger isn't just the larger loss. It's the habit you're reinforcing. Every time you ignore your stop, you teach yourself that rules are optional, that you can negotiate with the market, that you can delay consequences. But the market keeps score differently. It doesn't punish immediately. It allows the behavior to continue until the cost becomes undeniable. So instead of asking, how much am I willing to lose? Ask something better. Where is my idea objectively wrong? That question forces precision. It removes emotion. It anchors your decision in logic, not feeling. And once that level is defined, your job is simple. Not easy, but simple. If price reaches that point, you exit. No hesitation, no reinterpretation, no second guessing. Because by then, the decision has already been made. You're just executing it. Now consider what happens when you follow this consistently. Losses become smaller, more controlled, less personal. You stop reacting in the moment because you've already done the thinking in advance. And something else happens too. Your confidence shifts. It's no longer based on being right about the market. It's based on knowing that when you're wrong, you'll recognize it quickly and act without delay. Strong trades don't need your patience. Weak trades demand it. That idea runs against what most traders believe. You're told to be patient, to let the trade work, to hold through noise. And while patience has its place, it's often misapplied. Because not every trade deserves your patience. Some trades expose their weakness almost immediately. Think about the trades that worked best for you. The ones that felt clean. Did they hesitate endlessly after entry? Did they drift sideways, testing your confidence every few minutes? Or did they move with purpose, giving you little reason to doubt your position? Strong trades have a certain character. They align quickly. Price moves in your direction with intent. Pullbacks are shallow and controlled. Momentum confirms your idea instead of questioning it. There's a sense of ease, not because the market is easy, but because your timing is in sync with it. Now compare that to your losing trades. They stall. They hesitate. They move a little in your favor, then give it back. Breakouts fail to follow through. Trends lose structure, and instead of clarity, you feel tension. You start watching every tick. You start hoping instead of observing. Have you noticed how the trades that require the most emotional effort are often the ones that fail? This is where patience becomes dangerous. Because patience, when applied to a weak trade, is not discipline. It's denial. You tell yourself you're being strong, that you're sticking to your plan. But underneath that, there's often a quiet resistance to accepting that the trade isn't behaving as it should. Strong trades don't need to convince you. Weak trades do, and the longer a trade needs to prove itself, the more likely it is that the original opportunity has already passed. Ask yourself, when a trade lingers without direction, what exactly are you waiting for? Clarity rarely appears after prolonged uncertainty. More often, uncertainty is the signal itself. It's the market telling you that conditions are not aligned, that participation is weak, that your idea may not have the support you assumed. But instead of reading that as information, many traders interpret it as time. They believe that if they just wait longer, the trade will eventually work, and sometimes it does. But that's the trap, because occasional success reinforces the behavior. It teaches you that patience in weak conditions is justified. But over time, that same behavior leads to larger losses, missed opportunities, and a constant drain on your focus. Now consider the cause and effect. You enter a trade expecting momentum, price hesitates. You choose to be patient, hesitation continues. Doubt increases, you hold. Longer the trade weakens. Further your exit becomes reactive instead of planned. At no point did the market force you to stay. It simply failed to give you the confirmation you needed, and you chose to ignore that absence. There's a difference between giving a good trade room and giving a bad trade time. Room is defined by structure. Time is often defined by hope. If your trade is still structurally valid, if momentum is intact, if the behavior remains consistent with your idea, then patience makes sense. But if those elements begin to fade, if price no longer acts the way it should, then patience becomes costly. So what should you look for? Look for immediacy. Not speed, but intent. Is the market responding to your setup, or is it indifferent to it? Are buyers or sellers stepping in with conviction, or is participation weak and inconsistent? Because strong opportunities attract participation quickly. Weak ones struggle to gain it at all. And when you start recognizing that difference, you'll realize something important. You don't need to sit through every trade to find out if it works. You can read its behavior early. You can observe whether it aligns or resists. And you can act accordingly. But that requires letting go of the idea that patience is always a virtue. Sometimes, the most disciplined action is not to wait longer, but to step aside sooner. Because every moment you spend managing a weak trade is attention you're not giving to a better one. Every ounce of patience you invest in something uncertain is energy you're not preserving for something clear. Every second you hesitate, the loss gains control over your judgment. At first, the hesitation feels harmless. Price moves slightly against you, and you pause. You tell yourself you're just observing, just giving it a moment. That seems reasonable. After all, markets fluctuate. Not every move against you means you're wrong, but something subtle begins to change in that pause. Your focus shifts from reading the market to managing your discomfort. You start thinking less about structure and more about outcome. You're no longer asking, is this trade still valid? You're asking, can I avoid taking this loss? Have you noticed how quickly your thinking changes once you're under pressure? In the beginning, your decisions are clear. You define your entry, your risk, your invalidation. Everything is structured. But the moment the trade moves against you and you hesitate, that structure begins to weaken. Not because the market changed, but because you stopped following what you already decided. Hesitation opens the door. And once that door is open, emotions step in. Doubt comes first, then hope, then justification. It might turn. It's not that bad yet. I'll wait a little longer. Each thought feels small, but together they shift your entire decision-making process. You move from acting on logic to reacting to feeling. And the longer you stay in that state, the harder it becomes to return to clarity. This is where the loss starts to take control. Not because of its size, but because of your attachment to it. As the loss grows, so does your need for it to reverse. You begin to watch every movement more closely, not for information, but for reassurance. A small bounce feels like relief. A continuation downward feels heavier than it should. You're no longer neutral, you're invested. And that investment clouds your judgment. Ask yourself, when you hesitate on a losing trade, are you still thinking objectively, or are you trying to protect yourself from the discomfort of being wrong? Because the market doesn't wait for your clarity. It continues moving, regardless of your hesitation. And every second you delay, the situation becomes more difficult, not just financially, but mentally. Now consider the cause and effect. You hesitate, G, the loss increases, P, your emotional pressure rises, P, your ability to think clearly decreases, P, you hesitate again. This loop feeds itself, and it doesn't break on its own. The only way to interrupt it is through action. Early, deliberate action. Because once the loss reaches a certain point, your decisions are no longer clean. They're influenced. You start making choices based on what you feel instead of what you see. You hold longer than you should. You exit later than you planned. Sometimes you don't exit at all. And all of it started with a moment of hesitation. It's important to understand this clearly. Hesitation is not neutral. It has a direction. It pulls you away from discipline and toward reaction. It gives the lost time to grow roots in your thinking. That's why experienced traders act quickly when they recognize they're wrong. Not because they're afraid, but because they understand what hesitation leads to. They've seen how quickly control can slip, how easily a small mistake can turn into a larger one. So they don't wait for confirmation through pain. They act on recognition. If the trade is no longer behaving as expected, if the structure is weakening, if the conditions have changed, they exit. Not perfectly, not emotionally detached, but decisively. Because they know that clarity exists at the beginning of a loss, not at the end of it. And the longer you wait, the less access you have to that clarity. There's also another cost to hesitation that often goes unnoticed. It drains your focus. A losing trade that you haven't managed properly stays in your mind. It follows you. It distracts you from new opportunities. It keeps you anchored to something that is no longer serving you. So even if the financial damage is still small, the mental cost is already increasing. And trading is as much about mental clarity as it is about technical skill. If your mind is occupied, your edge is reduced. If your judgment is influenced, your decisions suffer. And all of it traces back to that initial delay, the moment you chose not to act when the evidence first appeared. So the real question is not whether you can tolerate a loss, it's whether you can act before the loss begins to think for you. Because once it does, you're no longer in control. You're responding. Hope delays action, and delay magnifies damage. At first, hope feels harmless. It even feels necessary. After all, every trade needs a little time to develop, a little space to breathe. You tell yourself that you're just being patient, just allowing the market to play out. But there's a fine line between patience and hope, and most traders don't realize when they've crossed it. Patience is grounded in evidence. Hope is grounded in emotion. Patience says, the structure is still intact, the idea is still valid. Hope says, I just need this to turn around. Have you ever caught yourself saying that? Because the moment your thinking shifts from analysis to wishing, your position in the trade has already changed. You're no longer managing risk, you're managing discomfort. And hope has a very specific effect. It delays action. You see the signs. The trade isn't behaving as expected. Momentum is fading. Levels are breaking. But instead of acting, you wait. not because the evidence supports staying, but because you want a different outcome. So you give it more time, just a little more. And in that extra time, the loss grows. Now here's the part that often goes unnoticed. Delay doesn't just increase the size of the loss, it changes your relationship to it. A small loss is easy to take. It's clean. It's controlled. It doesn't challenge your identity as a trader. But as the loss increases, it becomes heavier, more personal, more difficult to accept. So what do? You hope more. Because now exiting doesn't just mean closing a trade, it means locking in a larger mistake. And the larger the mistake, the stronger the urge to avoid it. This is how hope traps you. It starts small, it feels reasonable, but it compounds, and as it compounds, it reduces your ability to act. Ask yourself, when a trade moves against you, do you respond to what is happening, or do you wait for what you want to happen? Because the market doesn't respond to your expectations. It responds to order flow, to participation, to pressure. And when those forces move against your position, hoping for reversal doesn't change them. It only delays your reaction to them. Now look at the cause and effect clearly. You enter a trade with a plan, the trade weakens. B, you hesitate. A, hope replaces analysis. You delay your exit. A, the loss grows. B, your emotional attachment increases. You delay even more. At no point did the market force you into a larger loss. It simply moved, and you chose to wait. This is why delay is so dangerous. It feels passive, but it's not. It actively increases risk. It gives the loss time to expand. It gives your emotions time to take control. And once your emotions take control, your decisions follow. You start redefining your plan. You widen your stop. You ignore signals that you would have acted on earlier. You tell yourself that exiting now doesn't make sense, that you've already held this long. But that reasoning is not based on the market. It's based on the time and pain you've already invested. And that's the trap. Because the market doesn't care how long you've been in the trade. It doesn't care how much you're down. It only reflects what is happening now. So the only question that matters is, does this trade still make sense? Not 5 minutes ago. Not at entry. Right now. And if the answer is no, then delay only makes the outcome worse. Experienced traders understand this at a deep level. They don't wait for losses to become obvious. They don't rely on hope to carry them through uncertainty. They act when the evidence shifts, even if the shift is small, because they know that small signals, acted on early, prevent large problems later. They also understand something else. Taking a small loss quickly preserves more than capital. It preserves clarity. It keeps their thinking sharp. It allows them to move on without emotional residue. Because once a loss grows beyond a certain point, it doesn't just affect that trade. It affects the next one, and the next. It lingers. And that lingering comes from delay. From the moments you chose to wait instead of act. From the times you replaced observation with hope. So the goal is not to eliminate hope entirely. It's to recognize when it has taken the place of analysis. To notice when you're no longer reading the market, but wishing it would change. And to act before that wish becomes costly. Because the longer you wait, the more expensive that hope becomes. And the less control you have over the outcome. The inability to exit early is not a strategy flaw, it's a discipline failure. Most traders are quick to blame their strategy when things go wrong. A trade turns into a loss, and the first reaction is to question the setup, the indicators, the timing. Maybe this system doesn't work. Maybe I need something better. But look closer. Was the trade truly a failure of the strategy, or did it become a failure because you didn't exit when you were supposed to? This is an uncomfortable question, but an important one, because many strategies, even simple ones, can remain effective if losses are controlled. The edge doesn't come from being right all the time. It comes from keeping losses small and letting winners develop. But that balance only works if you respect the exit, and that's where discipline comes in. A strategy can tell you where to enter. It can suggest where you're wrong, but it cannot force you to act. Execution is entirely in your hands, and when you choose not to follow through, the outcome is no longer a reflection of the strategy. It's a reflection of your behavior. Have you ever held a trade past your stop, only to later say, "This strategy doesn't work"? In that moment, it's not the strategy that failed. It's the decision to ignore it. This is how discipline quietly shapes results. You can have a solid plan, clear rules, defined risk, and still lose control if you don't follow them in real time. And the failure is subtle. It doesn't feel like breaking discipline. It feels like adapting, like giving the trade more room, like making a judgment call. But over time, those small deviations add up. One delayed exit becomes two,